Welcome back. We're going to finish up our discussion of the income statement. First, I'm going to go have some dinner. We can come on over here. I'll let the kids, I'll say hi to you guys while they eat down on their dinner. Then we'll be right back and finish up some of our discussion of the income statement, particularly some of the other items that we end up reporting on the income statement.
Hey boys, what are you doing?
Cooking hot dogs. Cooking hot dogs.
What do we got here?
A fire.
Got some hot dogs?
Yeah.
Yeah.
Hey Mom, can I get my hot dog? And a fire.
And a fire?
Welcome back. Now that the kids had a chance to say hi to you while they finished up their dinner, I thought I would come over here and talk a little bit about how to report various items on the income statement. We're going to start with discontinued operations. So for discontinued operations, these occur when two things happen. When a company eliminates the results of operations of a component of the business, and the elimination of that component represents a strategic shift having a major effect on the company's operations and financial results. Now that means both now and into the future. That's what the shift means. They can't just spin off, say, one product out of a product line, for instance, or sell off some of their operations on the West Coast or in China or something. This has to be a strategic shift in how they're doing their operations. And it has to eliminate the results of operations of a component of the business. And how you define component, it can be a geographic component, it can be a product line component, any number of ways the company can determine that, that is a component of our business that we are eliminating. So a discontinued operation, the problem we have with a discontinued operation is that it's not going to continue. We don't want the results of that operation stuffed into revenues and expenses. We want to pull those results out of our reported revenues and expenses. So we pull those out and we put them all on one line called discontinued operations. Now that discontinued operations will have two components. It could have two components. One, it'll have net income or loss from the discontinued operation, which says do not consider this income or this revenues and expenses going forward because we're not going to have it. We've discontinued it. So net income of $50,000, we're not going to have next year because we sold off that segment of the business. That's the operations part. We also have a gain or loss from the disposal, which is oftentimes reported separately. So I could have a business that I sold for more than what I had invested in it or more than the asset value of it, which would give me a gain. If I sold it for less than the net asset value of that business, I would have a loss. So I have a gain or loss on the disposition of a business, or I have the net income or loss attributed to that business. Either way, both of those get pulled out of our main, what I'd say called our main income statement, and they get reported separately as discontinued operations. That way, we can have net income from continuing operations, which allows the investors to easily see one line item that says, here's what the net income is from continuing operations. If I expect this to continue in the future or get better or worse, I now know what my benchmark is. I don't have to somehow try to estimate, well, they sold this part of the business, what's that going to have effect on? That's taken out of the income statement or the net income from continuing operations right off the bat. So that is discontinued operations. Oftentimes, discontinued operations, as well as non-controlling interest, which we'll talk about in a minute, are reported net of income tax, which means the income tax associated with that portion of operations gets put into that line item, not the not income tax or the main income tax from continuing operations line item. So we have discontinued operations. We also have non-controlling interests. So non-controlling interests. So this is typically income from 50% owned subsidiaries that are consolidated. So the consolidation, you consolidate if you own, generally speaking, more than 50% of a company, of a legal entity. You consolidate it. Consolidation takes 100% of the assets, liabilities, and income onto your financial statements. 100% of it. Well, you may only own 75%, but you're putting 100% into your financial statements through consolidation. Now, that means 25% of that company, i.e. 25% of the assets of that company that are reported on your financial statements or your balance sheet, don't belong to you. They actually belong to the other 25% minority owners, the non-controlling owners. And if that company made $100,000, you report the full $100,000 on your net income statement, even though you actually only have claim to 75% of that. The 25% is due to, or it's earned by, non-controlling interests, the other 25% owners. Well, because of consolidation, now real quickly, the reason accounting does that is because if you have more than 50%, you generally control those assets. And accounting takes a control perspective in this case, in that if you control the assets, we want all of the assets you control listed on the balance sheet. We want all the income that you generated from the assets you control listed on your income statement. It doesn't matter that someone else has some small piece. You control them because you own more than 50%. Now, 50% is a general rule. There are some small exceptions that you'll deal with if you continue on in accounting. So it's a control perspective. That's why the 100% gets moved over, even though you only own 75%. So it's not like accounting's being totally irrational here. This is just how it's done. But the income from those subsidiaries owned less than 100% have other shareholders who are claiming some of that income. That piece of the income gets taken out through net income attributable to non-controlling interests. So here's what that generally looks like. Let's take Walmart, for instance. I like using Walmart because they have a lot of operations. They have stuff going on, and they're a massive company. There's other massive companies I could do, but they just generally don't have quite as clean of financial statements, frankly. So I use Walmart. They have a little bit of everything and not a lot of anything. So it makes it easy illustration. So let's take Walmart Consolidated. So Walmart Consolidated, they are going to own a lot of different legal entities. I don't pretend to know how many legal entities Walmart actually controls or owns, but let's say they have 100%. Walmart Consolidated has 100% of Walmart. They also have, say, 100% of Jet. Jet's an online retailer that Walmart purchased a number of years back. So they own 100% of Jet, is my understanding. They also own Flipkart. Now, they don't own 100% of Flipkart. They only own 77% of Flipkart, at least last time I looked. It might have changed. They're still buying and selling little slivers of that ownership. But my recollection, last time I checked anyway, they own 77% of Flipkart. That means there's 33% of Flipkart that's owned by somebody else. Other owners own 33% of Flipkart. Now, when Walmart consolidates its financial statements, the net income of Flipkart, all of that net income is going to get put into the consolidated Walmart financial statements. So all of Flipkart's revenue is going to end up within Walmart's consolidated revenue line. All of their expenses, 100% of their expenses, are going to end up in Walmart's consolidated expenses. We don't start addressing the other owners until after we report income from continuing operations. We report net income, and then we take out non-controlling interests. So net income or loss attributable to non-controlling interests. In this case, just this one little sliver for Walmart, 33% of the net income from Flipkart is going to go to non-controlling interests. And we're going to take that out of Walmart's net income line to get us from net income to net income attributable to Walmart shareholders. That's how that's going to end up getting reported. Now, both discontinued operations and non-controlling interests get reported what we call net of tax. Net of tax is an intra-period tax allocation. What we do here, we take the total tax for the period based on the total income for the company, and we allocate that within items on the income statement. So the income tax line item actually does not have the entire tax provision for the company. It only reports the income tax associated generally with income from continuing operations. Again, that's before income from discontinued operations and non-controlling interests. The tax associated with those two pieces get reported in line with those two pieces. So this is an allocation of tax within a period. It helps users understand the impact of income taxes on the various components of net income. In this case, income from continuing operations, net income, and income allocated to non-controlling interests. So the allocation is done based on the tax rate, typically. One way to think of this, so don't think of taxes like you do for your individual income taxes, where you have a tax form that you fill out, and at the end of the day, there's one line item that says income tax due or your total income taxes. Don't think of corporate taxes that way. Instead, think of corporate taxes as a tax rate. Now, thinking of them this way, your tax professors might get bent out of shape. Any of you tax experts out there might get bent out of shape. But from a financial reporting standpoint, this is the easiest way to think about it. Think about income taxes as a tax rate. Let's say that rate is 21%, which last time I checked, I think that was pretty much universal corporate income tax rate now. So we'll take 21%. What we do, let's say that there's no permanent items within our taxes. So there's no permanent items. That means the company is going to, on average, they will be paying 21% tax on all of their net income. Now, some of that might get paid this year. Some of it might get deferred because of book tax timing differences. But eventually, they're going to pay 21% tax on all of their net income. Therefore, income taxes are 21% of whatever income is before tax. So we report it tax. So what we end up with is income from continuing operations before taxes. Taxes is just going to be the rate times that number. So if it's 21%, let's say we have whatever, $100,000 of income from continuing operations before taxes. Our taxes are going to be 21% of 100,000. So it's $21,000 is our taxes associated with that. That's going to give us income, net income or earnings or income from continuing operations of what? $79,000. That's what our net income is from continuing operations. Now we're going to report discontinued operations, and that we're also going to have to reduce for the income tax portion of it. And what we're doing is saying, okay, well, let's say discontinued operations also made $100,000. This is for simplicity of calculation in this case. So let's say our discontinued operations also made $100,000. Now, what's the taxes associated with our discontinued operations? $21,000. And that $21,000 will get baked in there. So we'll say income from continuing operations or income from discontinued operations, net of tax, $79,000. We do the same thing when we get to non-controlling interests. So what this ends up looking like, another way to look at this and think through this. So let's take this if we didn't have this inter-period tax allocation, we would just report net income, income from discontinued operations, income attributable to non-controlling interests, and then net income before taxes. So we just add all those line items up, not net of tax, which we always would do in accounting. And that would give us, say, income before taxes. We then multiply that times our rate of 21%. That gives us our income tax expense. And then we end up with net income attributable to the company, right? That's just all lined up right there. Now, if we wanted to report that net of tax, let's say we need to report discontinued operations and non-controlling interests net of tax. What we do is we just take those amounts. So income from discontinued operations, let's say it's $10. Our tax rate's 21%. So tax associated with that $10 of income from discontinued operations is going to be $2.10. So roughly $7.90 or round up. So we'll say $8 is income from discontinued operations net of tax. We've taken the tax out, the tax being the amount of income from discontinued operations times the tax rate, minus the amount of taxes based on the tax rate gives us income from discontinued operations. So we just do that over and over, and then we end up with what we call our income statement with our intra-period tax allocation. So we'll have net income, our provision for income taxes of 21% of just our operating income, which gives us net income from continuing operations. Now we're going to take income from discontinued operations. Now we just calculated it, let's say is $8. 10 minus $2 worth of taxes gives us $8. Now we're just going to report the 8. That's net of the taxes on it. Note, we took the $2 of tax out of our provision for income taxes and put it in or netted it against our income from discontinued operations. We do the exact same thing on income attributable to non-controlling interests. And then our net income attributable to the company, it's the same regardless of where we put the tax amount. One of them, we just put it all in one line item. That's not GAAP, and that's without our intra-period tax allocation. The other one, we break our total tax out between continuing operations, discontinued operations, and non-controlling interests. It's the same tax. It's just how it kind of gets allocated on the income statement. The intra-period tax allocation makes it more interpretable and understandable to users of the financial statements. If we took a look at, say, Walmart's financial statements and how they do that, they do this. They show it right there. They have consolidated net income attributable to non-controlling interest. That's going to be reported net of income taxes. All companies have to do it this way. This is GAAP. That's how it's done. One last thing. So the last item on your typical income statement is going to be earnings per share. Earnings per share is your net income minus preferred dividends, because they're almost treated like an interest expense. Preferred dividends are not available to common shareholders. So we take net income minus preferred dividends, and then we divide that over the weighted average common shares outstanding. That gives us earnings per share. This is a significant business indicator. If you're a shareholder, this is the information that matters to you. How much did the company earn for every share of stock I own? If we take something like Tesla, I think their earnings per share for last quarter was something like 50 cents a share, which is not very much given their shares are trading at at the time, maybe that was probably before the split, $1,300 a share. You're obviously not buying their past performance. But anyway, so that's earnings per share. It's measured in the dollars earned for each share of common stock, and it has to be disclosed on the income statement. Now, there's again the equation: net income minus preferred dividends over weighted average common shares outstanding. Make sure you know how to do a weighted average calculation. Without that, it's going to be hard to figure out what the weighted average common shares outstanding are. All that means is, on average, what were the shares outstanding for the period. Weighted just means that if we had 100,000 and we issued 1,000 halfway through the year, then the 100,000 was the whole year and the other 1,000 was for half the year. That's weighted. So you can Google how to calculate weighted averages. I'm not going to go into that detail here, but make sure you can do that for share issuances or redemptions is kind of critical. Lastly, we'll just highlight how Walmart kind of discloses this. I will note there are multiple ways of calculating the shares outstanding. You will go into much more detail about how to calculate shares outstanding when you move on to kind of usually your second intermediate accounting class. Talks about basic and diluted earnings per share, and that's usually adjusting for stock options, in the money, out of the money stock options, how those get treated. That changes whether your basic or diluted earnings per share, based on how many shares are considered to be outstanding. So the companies also do have to disclose how many shares they calculated are outstanding using both basic and diluted. But we're not going to get into those calculations. That is far beyond the purview of just understanding the income statement. Just understand how the basic calculation for earnings per share works. With that, we're probably going to call it a night here. I'll probably wrap this up sometime tomorrow, probably shortly after breakfast. So good talking with you. Hopefully you learned something, and have a great day. God bless.
What's this? Is this your bed? Hey boys, what do we got in here?
Some camping?
Everyone all set up?
Yeah. We also got some sleepy children.
Okay, say goodnight.
Thanks for watching. Hopefully you enjoyed this video. If you enjoyed this video, give it a thumbs up. If you would like to see the next video in the series, click right up here. If you'd like to see other videos in this series, click down here. If you would like to subscribe and get updates, click right over here. Thanks for watching and have a great day.